Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your guide to paying only the tax you legitimately owe, with a side of calm and a chuckle. Today's topic: unlocking tax efficiency through strategic philanthropy. Giving isn't just generous. It's a lever that can shrink taxes, tame risk, and align money with mission. Whether you're a high-income professional, a small business owner, or nearing a liquidity event, I'll share ways to structure gifts, avoid preventable taxes, and build wealth while supporting the causes you love. Let's get smart and get giving. Why does giving build wealth? Because after-tax return beats pre-tax bravado. Smart gifts can trim ordinary income, capital gains, and AGI-based surcharges like the 3.8% net investment income tax and Medicare IRMA. Direct low-basis assets to charity to avoid embedded gains while keeping core positions intact. Gifts also smooth income volatility, stabilizing cash flow and risk, and aligning dollars with values boosts behavioral follow-through. Bottom line, fewer dollars lost to tax drag means more capital compounding for you and your mission. Let's tackle itemizing versus the standard deduction. If your mortgage interest, state and local taxes, capped federally, and other itemized deductions don't exceed the standard deduction, your charitable gifts may deliver no incremental benefit this year. Enter bunching. By concentrating 2 or 3 years of giving into one calendar year, often a peak income year, you push itemized deductions over the threshold and unlock real tax value. In off years, you take the standard deduction again. You still give the same overall amount, but you harvest larger deductions in fewer years. This timing strategy pairs beautifully with donor-advised funds, which I'll explain next. One powerful move is donating long-term appreciated assets, public stock, ETFs, real estate, even crypto held over a year. Contribute to a public charity or DAF, and you generally deduct fair market value while the built-in gain disappears. Limits apply. Typically 30% of AGI for appreciated property to public charities, with a 5-year carry forward. To private foundations, deductions are often limited to cost basis and 20% of AGI. Ensure the holding period is long-term. Short-term gifts are basis limited. Publicly traded securities need no appraisal. Real estate and crypto require a qualified appraisal. Donor-advised funds let you front-load deductions now and recommend grants over time. You make an irrevocable gift to a sponsor, get an immediate deduction subject to AGI limits, and then advise distributions to operating charities. Assets can be invested while you decide. Typical admin and investment fees run about 0.25% to 1% annually. Contribute by December 31 to deduct this year. Grants can occur later. No private benefits, no tickets or tables, and generally don't use DAF grants to satisfy legally binding pledges. Keep gift confirmations and grant letters. If you're 70, 1-2, or older, qualified charitable distributions from an IRA are a sleeper hit. A QCD is a direct transfer from your IRA to a qualifying public charity. It can count toward your required minimum distribution, but it never hits adjusted gross income, helping with IRMA surcharges, Social Security taxation, and deduction phase-outs. The annual limit is $100,000 per person, indexed for inflation. Coordinate between spouses. QCDs cannot go to donor-advised funds, supporting organizations, or most private foundations. And you can't also claim a charitable deduction. Timing matters. The check must clear before year-end, and inherited IRAs work too if the owner is at least 71-2. For larger gifts or concentrated positions, consider split interest trusts. A charitable remainder. Trust lets you donate appreciated assets, sell them inside the trust without immediate capital gains tax, and receive income for a term or life. You get a current deduction for the remainder interest, subject to AGI limits. Payouts follow a tier system and can be structured as a CRAT or CRUT. A charitable lead trust flips the script. Charity receives income for a period, and the remainder passes to heirs or back to you, potentially leveraging favorable interest rate assumptions. When do private foundations make sense versus DAFs? A foundation offers maximum control, the ability to run programs, hire staff, and make grants to a wider set of entities, including some individuals, subject to due diligence. In exchange, you get complexity, formation and annual filings, a 1.39% net investment income excise tax, self-dealing rules, and a general expectation to distribute at least 5% of assets annually. Deductions are tighter, cash gifts limited to 30% of AGI. Appreciated property often limited to basis, and 20% of AGI. DAFs are simpler, cheaper, and anonymous if desired, but you give up legal control and must work within sponsor policies. Business owners have extra levers. C corporations generally deduct charitable contributions up to 10% of taxable income. Unused amounts carry forward 5 years. Pass-through owners usually deduct at the individual level under personal AGI limits. Donating inventory can yield enhanced deductions. Qualifying food donations may equal basis plus half the appreciation, capped at twice basis, and limited by taxable income. Before donating marketable securities from a corporate treasury, compare corporate versus shareholder giving to optimize basis and QBI, and distinguish charitable gifts from sponsorships. Advertising benefits typically belong as business expenses, not charitable deductions. Facing a big taxable event, RSUs vesting, stock option exercise, a real estate gain, or selling your company, Philanthropy can be your shock absorber. Before you sign a definitive sale agreement, explore donating a slice of your appreciated shares or membership interests to a DAF or CRT. Done correctly, the charity becomes the seller for that portion, eliminating capital gains on the gifted piece and generating a deduction to offset other income. Timing and valuation are critical, and charities may require a qualified appraisal and representation letters. Coordinate with corporate counsel to avoid step transaction issues, and confirm the sponsor can accept closely held interests. Don't forget state and local coordination. Many states offer charitable credit programs. Great, but federal rules require you to reduce your federal charitable deduction by the value of any state tax credit you receive, aside from small de minimis benefits. Missouri is active here. Think Neighborhood Assistance Program, youth opportunities, and others, often with 50% credits. That's valuable, but model both levels so you don't double count. Also consider Missouri's pass-through entity tax election, a SALT cap workaround that shifts state tax to the entity. Electing PTE tax can change your AGI and itemizing picture, so sequence gifts, PTE payments, and estimated taxes deliberately. Compliance keeps plans on track. For any gift of $250 or more, obtain a contemporaneous written acknowledgement stating what, if any, benefits you received. Non-cash gifts over $500 require Form 8283. Above $5,000 generally need a qualified appraisal. Yes, that includes crypto. Screenshots aren't appraisals. Publicly traded securities are exempt from appraisal. For year-end gifts, stock must reach the charity's custodian, and mailed checks count on postmark. Watch quid pro quo rules. If you receive a dinner, tickets, or goods, only the excess is deductible. Avoid syndicated conservation easements, an active IRS enforcement priority. Charitable planning shines in estate strategy too. Traditional IRAs are loaded with income tax for heirs. Charities pay none. Naming a charity as the beneficiary of pre-tax retirement accounts can eliminate income in respect of a decedent while bequeathing Roth or taxable assets to family. A testamentary CRT can provide a lifetime income stream to heirs, then pass the remainder to charity, potentially stretching tax recognition and securing an estate tax deduction. If you worry about reducing family inheritance, consider life insurance held in an irrevocable trust to replace the wealth directed to charity. Coordinate beneficiary designations with your will and trust documents. 3 quick case studies, then a checklist. 1. A surgeon with a bonus bunches 2 years of gifts into a donor-advised fund, itemizes in the peak year, and grants out over time, netting a larger deduction without changing total generosity. 2. A 74-year-old uses QCDs to satisfy RMDs, trimming AGI, lowering Medicare ERM-AA, and keeping deductions simpler. 3. A founder gifts pre-sale equity to a CRT. The trust sells tax-deferred, pays her income for life, and leaves the remainder to charity. Checklist. Clarify causes, map tax goals, inventory appreciated assets, pick a vehicle, time contributions, and coordinate with your CPA and attorney. That's a wrap for unlocking the value of tax efficiency. Today we explored why giving is a wealth lever, how to bunch deductions, donate appreciated assets, use DAFs and QCDs, deploy CRTs and CLTs, weigh foundations, coordinate business and sale year strategies, model state credits, especially in Missouri, and avoid compliance traps. The real win is turning intention into a repeatable system that lowers taxes while amplifying impact. If this sparked ideas, talk with a qualified tax pro and a state attorney before acting. If you're in Missouri, bring your advisor a one-page map of potential credit programs and the pass-through entity tax election to prioritize sequencing. If you're elsewhere, the coordination theme applies with your state's quirks. For worksheets, ask your advisor for an asset inventory and giving policy template. They're tools that create momentum. Finally, remember, the best plan is the one you'll implement consistently. I'm David Robson. Thanks for listening to Tax Smarts Unlocked, where generosity and strategy meet.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.